point to fold would be too great, so they decided to rescue AIG. Now it's interesting, in the case of AIG, they'd written credit default swaps, so they were the issuer, they were the of these credit default swaps. Once the credit default swaps were called in, like an insurance on a loan, a credit default swap is like an insurance on a loan, they couldn't pay because they'd run out of cash because they were borrowing in the interbank market, and in addition, assets they held also had collapsed in value. So the Federal Reserve pumped money into AIG, and the major beneficiaries were companies like Deutsche Bank that were the counterparties. So they bought insurance from AIG. And it's interesting, this is an interesting example because for some reason, which is very, very difficult to understand, but part of the madness of the current economic policies, is that the ECB and other governments, in particular the ECB, have decided that no credit default swap should be paid out on. So it's kind of insurance. So in the Greek renegotiating the value of Greek bonds, one of the principal objectives is to ensure it does not trigger a credit default swap. So the issues of a credit default swap don't have to pay up. So even though bonds are being written down, they're trying to organise this on a voluntary basis, so they will not trigger a credit default swap. It will not trigger an event. So this insurance is called in. So that's very interesting, because the beneficiaries of that, of course, the people who have issued this insurance, that you have insurance from, like house insurance, your house burns down, but you don't have to pay up because the state says no, we'll intervene to ensure that doesn't happen. But it also, so this seems to be a complete waste of money, but it also protects the issuers of the insurance, who are likely to be firms like Goldman Sachs and other banks. Now, it's interesting in the case of Hungarian loans, that there have been credit default swaps which were called in by an Austrian bank called Erste Bank, ERSTE, and that led to large losses. So it's very difficult to know who's issued these, who are the counterparties, and what are the effects. But one of the key policies that's driving the current kind of mad ideas about within the Eurozone is that no credit default swap should actually be triggered. Very puzzling.
But ultimately, who is going to pay for these?
Ultimately, if a credit default swap, supposing a bank such as Deutsche Bank has issued credit default swaps to another bank which holds debt, credit default swap is like an insurance on this debt. The debt defaults, interest isn't paid. They then go along to Deutsche Bank and say, we want our money on this insurance contract. Well, now, what would happen is that Deutsche Bank would have to pay up. But supposing Deutsche Bank didn't have enough money, supposing as in the case of the French banks, they didn't have enough money, then the state will probably end up paying. But it depends on the liabilities. It's also interesting that a lot of credit default swaps are held by people who do not own debt. So it's like having me taking out a life insurance policy on somebody else's life. So I can take out this insurance without having what's called an insurable interest. Now, at the same time, the amount of credit default swaps in issue is a small fraction of the total debt in issue. For example, in relation to Italy, even for Greece, not all debt is covered by a credit default swap. But it's likely to be a much more actively traded market than in the secondary market for government debt.
Warren Buffett calls them weapons of mass financial destruction. Do you agree with that?
Yes, there's no doubt about it that one of the problems is that they're unregulated. They were assumed to have a risk profile which is unconnected with other financial instruments. In fact, a lot of these instruments are very closely correlated together. So once there's a default or a problem on one market, that very quickly spreads to other